This is already, according to the IEA, the worst energy shock that we have ever seen in history. 18 million barrels per day is no longer there, and you can't print oil. Where do all the chips, right, for the data centers? They all come from Taiwan. Well, Taiwan is almost entirely reliant on energy imports. They only have 8 or 9 days left of LNG. But what happens when the wealth effect goes in reverse? How would you know? Great Britain could very well have like a full-blown fiscal crisis, in my opinion.
There's 4 or 5 indicators, all pointing to the same thing. From a probability standpoint, the data doesn't lie.
Good morning, good afternoon, and good evening, everyone, and welcome to Macro Show on the Daily Stack. If you're tuning in on YouTube, if you're on Instagram, if you're on any of the social media platforms, specifically on Twitter, please make sure to give us a follow, a like, a retweet. Any and all of that helps the algo, much appreciated. But this week we are diving again into oil. Now, oil has been destroying global markets pretty much for the last month, 2 months plus since the war started. We are joined by Infra, who's going to break it all down for us, basically help us understand as to whether or not oil is going to continue this global wrecking ball through markets, and if so, potentially how we should be positioned. So welcome to the Daily Stack, Infra, and let's kick it off. What are you looking at this Thursday morning?
It's all about oil. So let's take a look at my updated math for the fundamental side of oil. So if you look at the fundamentals, obviously everyone's aware, Strait of Hormuz, that's been effectively closed. There's a ship here or there that gets through, and it's not militarily closed, but effectively it is closed. 20 million barrels per day, called 19 and a half, whatever, has been taken offline. Well, global oil demand was running at about 105 million barrels per day. And remember that with a physical commodity, supply and demand must equal out, right? They must balance. They must. And the way that they balance is through the price. And so right now we have the Strait of Hormuz closed. That's negative 20 million. That brings us down to 85 million barrel per day amount of supply. Then you have the damaged refineries, not just in the Middle East, but also Russia and also Texas too, with the Valero plant. So that takes that's another 5 million barrels per day. Then you look at the refineries that have been shut in, and this is according to JP Morgan. Right now we're at 11 million barrel per day shut in terms of the refineries. So even if the Strait of Hormuz opened today fully and completely, throughout the GCC, there's still an 11 million barrel per day shut-in, meaning that when you're an oil producer, normally you produce the oil, put it on a pipeline or a ship, take it to its destination, everything's good. What happens when those ships or those pipes can't take all the oil you're making? Well, you fill your inventories, and once the inventories are filled, you shut in the well, you cap the well, the refinery shut in. So that takes months to get back online. Now there are positive offsets. So right now, again, with the damaged refineries, with the
interruption, Phil. Let's just clarify. We want to make sure that we have all these numbers on screen so that people can follow. Let me just make sure that we have them on stage. Are you live? Yep, we are. Okay, so this is the math that you're running through, right? And you've just been describing what is in red, which is the supply shock.
The negative, yeah.
The negative lack of oil that is unable to get through due to the variety of 3 reasons you mentioned there. Now, you did mention one of those ships, or there are ships every now and then getting through. Is that like any substantial supply, or is that just specifically just for military purposes, patrolling?
No, there is oil making its way through the strait, just very, very small amount. Maybe you call that 19 million barrel per day reduction. The math is still kind of the math. People like to fight over every barrel, and it's kind of odd to me.
Sorry, traffic is through because
with their permission, they're paying a toll. That toll apparently is in yuan, Chinese yuan. And they're paying a toll to Iran. There's a whole kind of process that they have set up where the ship owner goes to an intermediary, that intermediary goes to the IRGC Navy Command. There's like a whole thing. But yeah, every now and again, a ship will get through.
It sounds
But
pretty sketchy. Sorry.
yeah, it
The
is.
whole process seems a
And
little bit.
and the yuan component of it, I think, is really notable. That maybe we could pull on later on, but yeah, that yuan component, they're paying in yuan a toll basically to make safe passage through the strait. So whether it's 19 million barrel per day, 20 million barrel per day, whatever, the math is still the math. Damaged refineries take another 5 million barrels off. Now the shut-ins, that is not in addition, right? That's not like on a, well, because what we're really trying to look at here is on a net basis, but from pre-war to post-war, pre-closure to post, to today. So that is what we're looking at here. For example, the Kingdom of Saudi Arabia, as a positive offset, they have an east-west pipeline that goes east-west. Now, the total capacity of that pipeline is 7 million barrels per day. But there was already oil flowing through about 3.5, 3. So the math is like, a little fuzzy, but I've done my best to, track what the big banks and, official sources are saying. And so that's a positive offset of 3.5 million because there is already oil going through there before the war. What we're looking at is replacing lost barrels from the Strait of Hormuz being closed, right? So the net change. So, total capacity, by the way, maxed out on this Yanbu pipeline is 7 million barrels per day, but there was already oil flowing through there. The strategic petroleum release, that is the 400 million barrels that the International Energy Agency has announced. According to now the 400 million is not really the number that matters. What matters is the flow rate of that 400 million. Well, according to Morgan Stanley, it's about 2 million barrels per day. There's another pipeline, the Fujairah pipeline, that goes from the bad side of the strait onto the good side, right? So you can bypass the Strait of Hormuz closure. That is adding in another 500,000. Again, total capacity 1.5, but we're looking for, there's already oil flowing through there. We're looking for offset. And then there's oil on water, which is floating oil, oil on a tanker. Most of it, a lot of it sanctioned that we have unsanctioned to try to bring some oil back in. That's about 1 million barrels per day. The problem there is it's going to be gone in 3 to 4 weeks. And also the other issue, I didn't make a note of it, but SPR, right? That International Energy Agency coordinated release of 2 million barrels per day. That is going to run out in another 2-ish months or so, depending on the flow rate. But
you're not actively able to replenish any of that at any stage whatsoever, or how does that? Because that's the SPR is the Strategic Petroleum Reserve, right? So that's
not just for America, but Great Britain, France, Germany, Japan's in there. Right. It's not just in America, but in America, actually, ironically, we do have about 415 million barrels total. So just to make that clarification. But yeah, once that is gone, if there's no oil coming, if you're Europe or Japan and all the oil you're bringing in is going to a refinery because you need it for gasoline, diesel, jet fuel, whatever it may be, that you're maxed out, so there's no flow coming in behind that to refill your SPR. So kind of the same kind of thing with the oil on water and the SPR. Once it's gone, it's kind of gone, and then that offset will turn into a negative. Also, you have the Fujairah pipeline I mentioned. This has been bombed. Now, there's conflicting information right now, but there is heat imagery from the NASA satellite that shows that this pipeline has been hit. And also the Kingdom of Saudi Arabia East-West pipeline. That one, again, total capacity, 7 million barrels per day. All it takes is one drone, one Houthi a drone or missile, or one Iranian drone or missile, you hit that Yanbu pipeline, you just took 7 million barrels,
So,
up
so
here in
you said
red.
7 million. What the 3.5 at the moment is current outflows, right?
That's the net
Imported.
increase. No,
Gotcha.
it's the, yeah. There was already oil flowing through there. What we're looking for is how much can we offset the 20 million barrel per day shock from the Strait of Hormuz. Yeah. So one strike on that pipeline, the Yanbu pipeline, and you just took 7 million barrels per day. You would put, up here in red, another 7 million reduction. That would take us to a shock that is worse than Q2 of 2020. And in Q2 2020, US GDP printed negative 31%. So at that point in time, the amount of economic activity in the US, we were shrinking by a third every year. Now, we printed money, we reopened, undid the lockdowns, and reopened, and everything was better. Here, we can't really do that. We can try to just end the war, wash our hands, walk away. Uh, but you're talking damaged refineries that can take years to bring back online. Iran hit a Qatari LNG refinery, took down 3.5% of the global LNG supply with a single drone. Actually, I think it was two drones. But two $20,000 drones took down that 3.5%, almost 4% of global LNG, and it's going to take 5 years to get back to repair. So, you hit the pipeline, the Yanbu pipeline, you hit more refineries, like, maybe there's potential for sabotage of the island, Karg Island. I remember, growing up, when Saddam lit his own oil on fire, if I can't have it, you can't have it, kind of thing. So there is a huge potential for this 18 million barrel per day reduction to turn into 25, 26, 27 million barrel per day. I mean, this is already, according to the IEA, the worst energy shock that we have ever seen in history already. You compare it to 2022, which is kind of the last time that we had a huge, move in oil, back with the other geopolitical thing right at the time, Russia and Ukraine. This, just on a fundamental basis, disrupted about 1 to 1.5 million barrel per day. So you're talking something like 8, 9 times worse.
And the oil price is starting to sniff this out, or to react to this, right? Which is really what the, at least, scary or potentially scary scenario is. I mean, in the last half an hour, oil rallied back to 112. It dipped slightly and then rallied back, dipped slightly, rallied back. It's been an absolute tear for the last day or two, and it's not an April Fool's joke. Legitimately, oil seems to be sniffing out and pricing in, finally, these potential for further supply shocks, based on those line items that you had in the math.
I don't think it's pricing in further. I think it's just pricing in current. If you look at like the forward curve, which I've been watching on WTI at least, it has been, called $100 front month, 75, 77, 78 on December, which, is indicating that the market has been believing this is going to be just, a couple weeks, 2 weeks, and that's it, right? But what the market, I think, is indicating with that $112 WTI price is the degree to which, reality and the market, the paper market, that was pretty out of sync, in my opinion. It was, and also, by the way, like, I'm not, an oil expert, so I do my best to listen to those that do this all day, every day, and they have been surprised that oil is not higher, much higher, right? Because oil is very, very inelastic. So to destroy this much demand, given that price elasticity of demand, PED, there are some things, right? If the price goes up a little bit, you just stop buying it, right? Maybe a iPhone might be pretty elastic, right? If the price of an iPhone goes up by $50, people just stop buying it, right? So very elastic. But oil is very inelastic, meaning that the price has to go up really, really a lot to get people to reduce their demand, reduce their consumption of oil and refined products, about 0.1, but it can be as low, according to the Fed, as 0.06, which means that for every 1% increase in the price of oil, demand only falls by 1/10 of 1%. So what that means is that to destroy this much demand, 18 million barrels per day, you have to have the price go really, really high. Now the issue is you can't print oil. Back here in 2020, remember that oil had to go negative on this day, April 20th, 2020. So on April 20th, 2020, kind of like to what you were saying, the market started to go, oh, demand is not, maybe this whole virus thing is actually serious. You got a big gap there, right? Markets pricing in, and then you had the like, oh, expletive moment, where supply, which had been kind of ramping up as normal, right? The economy was fine in 2019, 2020-ish, right? So supply was just chugging along. It was demand just fell off a cliff. And in order to balance supply and demand back then, it was the inverse of what we're talking about today, which is you had a negative demand shock and supply was constant. Now what we have is demand is constant, supply is being negatively impacted, and yeah, oil had to go to negative $40 per barrel to clear that market, and it all happened in one day, right? So oil here closed Friday the 17th, closed at $18. Then Monday, wow, this is kind of kind of a little with the long weekend. This is interesting. So Friday it closed at $18 per barrel. Then on Monday, or this would have been Sunday evening,
Yeah.
it opened at 18, went to negative 40, and then closed at negative 37. By the next day, it opened at 21, right? So it was very, very sudden, very, very quick. But that was what was required to get the market to clear, to get that supply demand imbalance to clear, was oil had to go negative. Then of course,
sorry,
here,
do these price elasticities work to the downside and the upside, right? There's no,
yes, yeah,
they're directly the same, except just with a negative in front of them.
yeah, they're inverse. So now the long run there for the price elasticity of demand, the long run is higher. Meaning, over two, just imagine oil goes to $500 per barrel, extremes inform the means, $500, and you can't afford to get to work, you can't afford this, you can't afford. Well, you're going to find a way to figure it out, right? You're going to maybe get an EV. Maybe public transport gets ramped up, right? They put new routes on the public transport.
You're telling us we should buy we should buy Tesla stock at the moment, right? Based on
It is
the potential.
a thought I've had, yeah. Because yeah, over the long run, right? People can make substitution, they can make changes to lifestyle. You can find, like for example, with internal combustion, maybe we realize, oh, ethanol is a great fuel. It's renewable, it's high octane, it's cheap, very cheap. It's like $2 a gallon here in LA, where premium is like 7, right? So maybe it's ethanol, right? Who knows? But over the long run, you do have the ability to destroy more demand with a lower price. And that, you're talking kind of 6 months, 9 months, 12 months, 18 months for the long run elasticity. But in the short run, it is very, very inelastic. And so again, given that during 2020, we had a negative demand shock of 23 million barrels per day, and given what we have today, which is about negative 18 million barrels per day, roughly equivalent, this is what the pink bars pattern here shows, kind of, the price action from here to here, right? Where we had, again, the inverted fundamentals, where you had demand falling off a cliff by 23 million barrels per day. This is what it is doing. I mean, it's tracking perfectly. And it indicates, 150-ish WTI. So just, no one really knows where all this is going. But like one way I'm thinking about it is, okay, if 2020 was a historically large negative demand shock on oil of 23 million barrel per day demand shock. And today we're talking about the largest energy supply shock in history, according to the IEA. Then it's basically the best analog to inform. Right, it's not like a hard and fast thing. I'm not using this to trade oil or anything, but just to kind of inform how it may play out. And I originally did this back here. In mid March is when I
Well, sorry, can we
first
get
put
into
this.
that analog? Because I think it's important to, I guess, use first principles. In terms of analyzing a supply shock versus a demand shock, are there any potential gaps that we would be missing by inferring that one is similar to the other in reverse? Because that is something that, I mean, we could see I don't want to say a secret stash of oil, but for all we know, the UAE has some offshore, like, I mean, the incentive is for them to right size the ship as quick as possible, or do they want to continue with having oil prices as high as possible because in the long term that's profitable for them? Like, how are they looking at this, and does that factor into the potential for there being kind of a logical misassumption in assuming, hey, just because we have a supply shock where or a demand shock where oil went from 80 to negative 40, we can flip that in reverse and say the difference between 80 and negative 40 is 120. Let's put 120 on 80 and say roughly oil might spike again to 200 because of that inverse relationship. Do you know what I mean? Like, are there any like fallacies that we're potentially falling under
Yeah.
making that assumption?
Yeah, for sure. This is worse than 2020. Because in 2020, that demand shock, and remember, when we're talking about oil supply and oil demand, when you hear the word demand, really what we're talking about is consumption, oil or energy consumption. And really, when you're talking about oil consumption, you're talking about economic activity, just,
Well, sorry to
for
interrupt.
the
Yes and no, because, and I think that's a super important classification between demand and consumption, because demand can create, you can use psychology to infer greater demand. Like when people go and buy toilet paper at the store, right, to go hoard in the future, that's quote unquote demand versus consumption, which is actual normalized usage. That's usually how I think about it. And maybe
yeah,
the difference is not that important, but there is this further upside, as you're mentioning, where like people could go and potentially
hoard.
hoard oil. Not people
Yeah,
necessarily, but there could be that mindset.
absolutely. Yeah, and we're already seeing it. You could argue that that applies on the negative demand too, right? Like I'm trying to remember back January, February, like maybe people panicked a little bit in terms of, oh, I can't go outside because there's a virus, right? You could get it in reverse. But yeah, this is worse because how do you I mean, and we're already seeing hoarding already. Like weeks ago, we started to see the hoarding in most of parts of Asia, even parts of Europe. We've been seeing hoarding. I mean, like there was like hundreds of French petrol stations that were running either low or completely out of certain grades of fuel already. And this was like 2 weeks ago. In Asia, Philippines, there were lines like half a mile long to get petrol. There was physical fights in India that I saw, people fighting physically over petrol. So yeah, there's really, how do you quantify shock
Yeah.
and panic and fear and it's how do you, we can do the math here, right? But like once that starts to get going, you really get issues. And at the end of the day, one of two things must happen. um Either we're going to have shortages, right? Because there's 18 million barrels per day of oil that should be there, there's just not there anymore. Either you get shortages or you get a price that is so high that the individual decides I'm not buying, right? That's really demand destruction. And theoretically and like perfectly free markets, that is what should happen, is the price gets so high. But what we've seen is, whether it be here, they've talked about doing this here in America, Europe is talking about doing it. Japan, South Korea is also talking about doing it. What we've been seeing is policymakers have been trying to intervene in free markets and cap the price, right? Or give money to individuals for oil, for petrol and gas and diesel. So either you get a price in a perfectly free market that goes to $200 per barrel, which is what theoretically should happen according to the negative 0.06, negative 0.1 range of elasticity. Either you get that move to $200 Brent and people just decide, I'm not buying, I'm not going on the vacation, I'm not, going to work, whatever it may be. Either you get that or you get shortages. And the more that governments try to intervene, right, with capping prices or, these like dividend things, helicopter money for energy, the more we get that, the more you're just going to get shortages. Because again, 18 million barrels per day is no longer there and you can't print oil. So, yeah, one of two things kind of must happen. But 2020 was worse. 2020, the government could just go, okay, lockdown's over, right? Demand or consumption, economic activity comes back fairly quickly. Like I remember, came back fairly quickly. And they printed $5 trillion. So I actually have this for kind of another point to make. But yeah, here in red is M0. And we went from 3 to 6.5 trillion just on base money.
Sorry, can you just classify M0 and why you
Base money, which is this is bank reserves, right? So what the Fed can control when it comes to the banks and bank reserve, and then currency. Currency growth is relatively pretty stable. What is fluctuating here is bank reserves. So yeah, so just on base money, we went from 3 to 6.5, so call it 3.5 trillion of base money printed. But if you look at M2, I mean, we went from 15.5 trillion to 22. So another 7 trillion of broad money. There's a bit of a multiplier, but you could do that, right? You print, I always say like, okay, if there's a demand issue, right, consumption, economic activity on that, you just print $20 trillion in an afternoon.
And that's how you fix the panic, right? Is you have a lever that you can pull to potentially solve for
in a demand shock.
In a demand shock, you have, or at least the potential for leveraging that lever to fix it and restore that confidence. But what I think you're getting at there is there's no
lever like that.
On the supply shock side, because it's just you have to wait for the oil to pass through the strait in order to get to where it's going.
Well, that's kind of the other thing too is, we're talking like the physical world that doesn't operate instantaneously like a paper market, would, like the stock market or whatever, right? The bond market. That we're talking the physical world now where, the oil's got to be taken out of the ground. That takes people, it takes energy, it takes time. Then it's got to be stored. Then it's got to be put on a ship. That ship needs fuel. The ship needs people. The ship needs to be insured, right? Then the ship has to transit all the way to Europe or Asia, wherever, right? All of this, it takes time. Yeah. So it's not a light switch where we can just turn this on instantaneously. If, for example, damaged refineries, that's going to take years to get that 5 million barrels back online, whether it be in Russia, whether it be Middle East. The shut-ins, again, I'm not an oil the oil, whatever they're called, oil engineer kind of person. I'm not that, right? But like I've done my best to learn what I can, and it takes months to get that back online. So yeah, that's another 11 million barrels per day, according to JP Morgan. Yeah. If the war,
what you're arguing then is not necessarily, it's not worse because of changes in the inelasticity of a demand shock versus a supply shock. You're arguing it's worse because the time it would take in order for that to recover is likely much further prolonged in a supply shock because it's the real world that you're dealing with and not financial engineering that you can outsource that problem to the Fed in order to come back and bail you out. And the crazy part about all of this to me is it sounds like everyone and their mom has been talking about V-shaped recoveries and the Fed's going to print and come save the day. But this is not a scenario necessarily where that might be likely
Doable.
or possible, not likely, but more perhaps probable or possible. So everyone's been like the markets have been pricing in this Fed put, if you want to call it. And now all of a sudden you take that away because energy is not something that, as you keep saying, is, you can't print molecules, you can't print the oil that's required. So that factors even further into, if we are going to get, even if it is a minor recession, it's unlikely to be, or is it fair to say or assume that it's unlikely to be a V-shaped one?
I think the likelihood of a V-shaped recovery is lower. Depending, it really depends on what's going on in the Middle East. If what's going on in the Middle East gets worse, or goes on and gets prolonged, then yeah, it's not going to be a V-shaped recovery. If there's more damaged refineries, if there's issues in the Red Sea and the Houthis get like, there's a real potential that it is not a V-shaped recovery. And it really comes down to how long is the physical supply being reduced. And unlike Q2, where it was a demand issue, you could flip a switch. This time you can't. And so it ultimately depends on kind of how the whole war, how the whole geopolitical, all that, kind of really depends on that.
Yeah. Okay. I do want to move away from oil because even if it is such a dominant factor, there are a couple other things that I think are worth maybe taking a quick dive into. And the topic that I want to get into is, let's exclude oil for a moment and look at some of the other potential recession indicators that you've been analyzing. And I know one that you mentioned previously was the luxury goods, and the fact that those luxury goods stocks, whether that be Ferrari or LVMG, they're basically very, very bearish, which is, I mean, if there was ever a recession indicator to look at, that's something that I would flag, right? I mean, that for me is a substantial sign of weakness for that upper 1 to 3% of the economy. I'm not sure exactly what group that represents, but is this a recession indicator, or is this just cyclical movements up and down of some of the more luxury goods manufacturers?
I think it's both. I do think that we're seeing a lot of late cycle sort of things. The pop in commodities. You look at the labor market, which has not been doing well, and there's signs of cracks kind of everywhere in the labor market. You look at credit spreads, what's going on with private credit. I think that's kind of very late cycle. So yeah, no, I think LVMH is just kind of one of many. And they, I don't know, like maybe top 5% of income earners are shopping at LVMH, maybe top 10. I'm not really, I've never bought a Louis Vuitton anything, so, or any of those other brands, so I don't know. But it is definitely luxury. Now, granted, this is a global brand. It's a European company. It's a global brand. So with that disclaimer kind of out of the way, yeah, their stock has been getting hammered, and their earnings have fallen from the first half of 2024, about 14.5. Is this EPS? This might be EPS. Either 14.5 earnings euros per share, or 14.5 maybe million. Their earnings have fallen, and the stock has been getting hammered. The stock is in a bear market, so from the high there, we're down 50% going back. It looks like the high was printed in mid 2023. And yeah, you can see that it's, obviously had volatility, but in general, this doesn't look super great. And, kind of another one that you might look at is Ferrari. Right. Like they're definitely in the top, probably 5% of income earners. They're buying Ferraris. So, also Ferrari in a bear market, like this doesn't look good either.
Yeah.
And when the reason we care is because so 2/3 of GDP comes from consumer spending. Of that 2/3 of GDP that is consumer spending, half of it is the top 10% of income earners. And they have felt, very, very rich due to the fact that we've had double-digit years kind of back
Yep.
to back in the stock market, right? So they feel rich, they spend, the wealth effect. But what happens when the wealth effect goes in reverse? How would you know? Obviously, you can look at the stock market, right? If it, which is had a bit of a hiccup.
Yeah.
So there's potential that impacts, negatively impacts, sentiment amongst the top 10%. They pull back on spending. And how would you gauge whether or not they are pulling back on spending? In my opinion, you could look at LVMH.
Yeah, there was one other quick thing that I wanted to share, which I thought was quite telling. This is Saifuddin Amusi. I don't know if you're familiar with him. He wrote the Bitcoin Standard. He was calling out this chart that the bar chart was discussing was a periodic reminder that diamonds are also shitcoins. So this is the diamond price over time. I'm not sure how directly influential this is to LVMGH specifically. But again, it is another interesting indicator of prices collapsing. Now, there is that whole secondary market of, lab-grown diamonds, which is probably also playing into this. So it's definitely worth monitoring. But I just think it's interesting that we're seeing those luxury providers, or the share price of those luxury manufacturers start to already take a hit.
Yeah, and we know that economic activity must fall by a lot, really a lot. If this war goes on, 18 million barrels per day of economic activity, of consumption, of demand must go away. Well, how much is that? In Q2 2020, it was 23 million barrels per day. That's what the world looks like when 23 million barrel per day of consumption or demand is removed. That's what the world has got to look like. And this is what GDP printed, apparently 28%. I don't know if that's TradingView or maybe a revision or something, but yeah, basically a negative 30% to US GDP. It's kind of equivalent roughly of, the global economy. Everything's doing well. Obviously, America is a huge share of GDP, I think about 26%. It's kind of sort of roughly equivalent to taking American economy, America, to zero in the global economy. I mean, it's catastrophically bad. There's no way to print oil and make this any better. It is catastrophically bad if it continues. And yesterday was kind of a opportunity to maybe have an off ramp and just, okay, we did our thing, we're gone. Try to pull back, but we didn't. If anything, I would say it was pretty hawkish. So yeah, the world has got to look like. Now, maybe America, maybe we see, a 5% reduction. But that all that means is emerging markets must see 25,
Well, so this
thing.
is kind of the next topic that I wanted to hop into was, are we too bearish in this whole scenario? I mean, you're looking at those numbers and I mean, look, that's back of the napkin math, right? It's not down, it's perfect down to the 0.1 million. But as a line in the sand, I'd say it's pretty damn accurate. And if you're out by 1 or 2 million barrels, at the end of the day, it's the substantial, or the quantifying the extent of the shock as a whole. If you're 90% accurate, that's all that really matters. So
Even
with that in
70,
mind,
even
with that
70,
in mind,
even
are we too
60,
bearish?
because like 2022, again, we got a bear market in the stock market. We got two consecutive quarters of negative GDP in 2022. What was the disruption then? The disruption then was 1 to 1.5 million. So even if I'm really, really off, and Morgan Stanley and JP Morgan and a lot of the sources I'm using, which are pretty reputable, even if we're all just like way off by like 60%, you're still talking something that's like 3-4 times worse than 2022, where we got a recession, which just definition was changed, and a bear market and stock market. So they're like, we're so far past like, a potential kind of delineation. And, Trump always, talks about, well, yeah, but, we are a net exporter of oil here in America. Okay, that is true. But then you look at the composition of GDP, if we're a Middle Eastern country where 50%, some of these countries, more than 50% of our GDP is oil, natural gas production, exploration, that kind of thing, then sure, yeah, higher oil is actually good. Like Norway, if there's any country I'm bullish on, Norway, for every 10% increase in the price of oil, Norway's real GDP goes up by like 1.9%. So if a huge share of your economy is oil and related industry, then yeah, you will actually do well from higher oil. Russia's another one. But American GDP, you look at our GDP, only about 1 to 1.5% comes from oil. So 65% comes from consumer spending, which is going to be hit. I think even $110 WTI is going to be enough to get people to pull back. Because remember, we haven't even really had like the full effect. It takes a bit of time because we're talking about the physical world. Takes a bit of time to trickle into gasoline, diesel, jet fuel. Like we're just starting to see the jet fuel shortages, for example, in Europe, in Asia now. There's a lag to this. But there's also a lag to it getting back up and running.
Yeah,
So we're
I mean,
kind of like in the V, where the effects from the start of the war are just kind of starting to hit. And if we stop the war now and just tried to take it back to pre-war conditions, it's going to take some time, as well to kind of come out of it. So
yeah.
um
This is the Norwegian stock market, in case anyone was wondering. Take a guess when the war started, and look at their index. It's just been crushing it. It's up
yeah.
what 620. That's 33% in the space of 3.5 months or 4 months. It's crazy.
I'm normally not bearish on the economy or kind of risk. I haven't been for 4+ years, but so it's a very like unusual feeling, and I definitely am trying to really kind of think about it and steel man everything, and really analyze, should I really be bearish? Is a recession coming? That kind of thing. And I've thought about it a lot. I mean, I sit at my desk, 10, 12, 14 hours a day
Yeah.
watching all this stuff, thinking about it. And it just is that bad, and it's not only oil, right? Private credit,
Yeah.
which is heavily software exposed. Some of these books are like 40-50% software being disintermediated by AI. Also have the issue of what sector in the American economy has been propping everything up. Well, it's AI. Okay. AI, where's a lot of that 18 trillion of pledged investment coming from? It's coming from the GCC. Well, that's fine when they're running 25% current account surplus, as a share of GDP, because by definition, 25% of GDP, capital and financial account deficit, right? They're creditors to the rest of the world. That makes sense. But what happens when their current account goes to zero and negative? Kuwait in the early 90s, their current account went to negative 25% of GDP, or excuse me, 250% of GDP. I mean, just like unbelievable levels because again, remember that a huge share of their economy, differing, but half in some, actually over half in some of the GCC is oil. So when oil, gets hit, you really get hit as a kind of your current account and your overall economic situation. So they're getting hit because they can't export and make money. Half of their economy is really severely impacted. By definition, that means that all that inbound capital that they were going to go spend in AI data centers, all that is just not. It's going to dry up, right? Everyone talks about trade disruption, but no one ever talks about capital disruption, which is on the other end of it, the other side of the ledger, kind of, right? Trade is capital flows, international capital flows, by definition. So the one sector of the American economy propping everything up, heavily reliant on GCC pledged investment. Well, GCC current accounts are getting hit already. It'll be a month or so before we get data, but already Saudi Arabian oil exports are down 50%, 50, right? So
Wow.
they're going to get pushed into current account deficit, probably the longer this goes on. That means that not only will they not be providing credit to American data centers, they're going to have to be selling something to raise dollars to fund the current account deficit. Well, what do have they accumulated? Huge amounts of US treasuries, huge amount of gold, right? Foreign exchange reserves. Well, you start selling those down, you get the move we've seen in gold. Because also they have a peg, currency peg, dollar peg that they have to defend. And we can see kind of like Bahrain, especially. This was pre-war. This is what their
Yeah.
exchange rate looked like to the dollar. And
Look at the
here's
volatility. As soon as
yeah, it's
it's all those UAE, Kuwait, Bahrain. That's crazy.
yeah. So they have a currency peg to defend. Their current account surplus, which they had kind of planned on always being there, is not there anymore. So not only are they not crediting, right, providing investment to AI data centers, the one sector that's been propping everything up, not only that, but they're going to be selling US treasuries, US equities, right? Kind of go down the list. So the one sector of the economy that's propping everything up is heavily reliant on investment from an area that is basically going to zero in terms of economic growth. That's kind of a problem, but it gets worse. If you look at where do all the chips, right, for the data centers? Well, they all come from Taiwan. Well, Taiwan is almost entirely reliant on energy imports. They only have 8 or 9 days left of LNG. Electricity is just going to go off, right? Like there's going to be blackouts if they don't get
Well,
more
it becomes a
LNG.
race to the top in terms of the oil price, because you just have everyone without a choice, and they have to
Yeah.
bid that up. It's
Otherwise the factories that make the chips don't have power, kind of
Yeah.
a big deal. And it actually gets even worse. Helium is part of the production process. I think it's to cool the chip, right, as they're manufacturing it. I believe it's cooling. Well, helium, if you look at where Taiwan gets all their helium, like a third of it, 30 or 40%, comes from Qatar, which we're seeing force majeure for years out, even from Qatar, and with regard to their helium and natural gas as well. So like the AI thing, the data center thing, which was a huge boost to US GDP, that's severely at risk. But then it gets even worse because Europe, Asia, we have a massively huge net international investment position, negative net international investment position. Foreigners own $69 trillion of dollar denominated assets on a gross basis. On a net basis, I think it's 26, 27 trillion. I could try to pull it up here actually. 26, 27 trillion. That is the difference between what foreigners own of our stuff, financial assets, and what they own of our financial assets and what we own of theirs. That is the NIP. And we have the most negative NIP in the history of the world, from what I've been able to find. Yeah, $28 trillion difference on a net basis between what we own of the rest of the world's financial assets and what they own of ours, which is in red here.
Wow.
And so what that means is you get a higher price, higher Brent price, and higher oil price. Well, that's priced in dollars. And by definition, if you're a net energy importer, your currency has been weakening. So not only is the price of oil going up in dollars, but in euros, in yen, in won, it's going up even more, meaning that the burden, the effective bill and the effective burden for you to import that energy is higher and higher and higher. So how do you, if you're France, you're already in a current account deficit. You just pro-cyclically run current account deficit. Great Britain also. Great Britain could very well have like a full-blown fiscal crisis, in my opinion, if this goes on. We saw, by the way, the repo usage from the Bank of England, 100 billion earlier today, 100 billion pounds. So there might already be signs of stress. Their gilt market has absolutely imploded. I mean, it's really, you have to go back to like kind of the Liz Truss moment to see a move in rates like we've seen in Great Britain. So yeah, they're going to be sellers of US treasuries. They're going to be sellers of US equities. If you sell US treasuries, what does that cause? Higher interest rates. Well, what do higher interest rates do? They constrain economic activity, tighten financial conditions here in America. And then that strengthens the dollar because there's higher rates cause more dollar inflows, more dollar strength equals higher burden on Europe, on France, whoever, Japan. Higher burden means more selling. More selling means higher rates. Higher rates attract more dollars into the dollar, into US Treasuries, on and on. It's a reflexive loop on the US Treasury side. On the US equity side, it's bad as well, because you start having foreigners selling stocks, and what does that do to the wealth effect that we were talking about earlier, right? When the stock market's going down because 2022 foreign stock holdings declined by 1.3 trillion dollars in the last energy shock in 2022.
Wow.
And remember, this is 8 or 9 times worse in 2022.
And
So,
potentially prolonged as well, not just extend to the upside as a one and done. Because for me, that's really where the risk is, in being able to price that extended period of time. And every day that this drags on, it becomes a higher and higher probability event, right?
yeah, I mean, in Great Britain, their 10-year gilt is up 60 basis points since the start of the war. If you look at what they're short at the front end of the curve, it's indicating 3 interest rate hikes, 2.5. So, and that's into an already weak economy, where per capita GDP was like 0 already. So, yeah, I mean, I don't know. I just don't see how you I just don't see why you wouldn't be bearish, I guess.
Yeah.
Like what?
That's a long answer to a difficult question, I guess, because I'm also looking at this from not only the oil standpoint, but how many late cycle indicators do you need in order to validate a thesis or to have a high probability of an event occurring? Because that's really how we should be pricing, or at least managing our risk, is based on probabilities. And if that's the case, then there's at least 3 or 4, if not more, late stage cyclical indicators. And again, I'm not a huge fan of necessarily like the business cycle itself, because I think the timing thereof is difficult. But I mean, how much more clearer could it be if you were to ask any quote unquote macro analyst who follows the business cycle as to what they would look for late stage signs that were likely to go into, whether it be a large recession or a small recession? They would all point to the 3 or 4 things that we've just covered, right, in the last hour or so.
And yeah, and there's another, which is the yield curve. So if we look at, for example, I look at the 230 spread, so the difference in the 2-year yield and the 30-year yield, and that's the pink line here. So we had been in a curve, steepening, where the difference was growing wider. It was a bear steepener, then it was a bull steepener. Generally, ahead of a cutting cycle, you'll get a bull, or into a cutting cycle, you'll get a bull steepener where short rates are falling really quickly. All rates are falling, but short rates are falling, more quickly. We had kind of seen that, but then we have been starting to get this flattening of the yield curve, and it's been a bear flattener. So the difference is growing narrower, right, between the 30-year yield and the 2-year yield, and it's happening as a result of bonds selling off or yields going up. So a bear steepener is a bear flattener is also what we saw ahead of 08. Because what a bear flattener is indicating is, number one, uncertainty about kind of economic growth. Now geopolitics is in there as well, but also expectations of rate hikes. And so, if you look at what happened going into 08, so here in 06, I think was when the yield curve inverted. Oh no, it inverted. Yeah, 06. Yeah, early 06, the yield curve inverted. So, I would recommend people watch the bond market, because obviously we got that yield curve inversion. When was it? 2023, and no recession happened. So people are 2022, 2023, and it was a pretty significant inversion, depending on the spread you look at, and no recession came. So people kind of have stopped kind of caring what the yield curve is doing. But if this
There's always been
flattening,
something happens. As soon as people stop caring or stop analyzing and
Yep.
giving attribution to certain things, that's typically when it's like, oh, we should have been looking at this the whole time. And when reality is like,
Well, and
If you've been following it.
everyone had a steepener trade on. Everyone was along a steepener. So positioning was also probably pretty stretched. And so yeah, so we're right now twos 30s is at 109 basis points. You can look at twos 10s as well. We're still not inverted. We're still a fair bit away from being inverted. But generally a bear flattener like we've been getting, generally that's really not good for stocks and kind of the overall economy. So yeah, there's a number of indications that
Wow.
yeah.
Okay. Well, on that note, Info, I guess maybe let's just quickly sum up what those 3 or 4 late stage indicators are, just as a summary, because I do think that we've covered a lot of ground. Do you want to give a quick wrap up of that, and then we can call it, because we are a little bit over.
Yeah, so we're getting a move. I wish I had the Michael Howell has a great capital allocation diagram
Yeah.
with the business cycle. So I would recommend people try to find that. It's really, I think, really good. We're getting the move in commodities, which is a very late cycle sort of indication. We can see right before 08. So commodity index peaked in July of 08. You're getting that. You're getting stresses in the credit market. Now, credit spreads are still tight, like high yield, for example, but they are starting to widen a little bit, right? And private credit is starting to have issues. Maybe it's nothing, who knows, right? Private credit is very opaque, but you have kind of that credit cycle going on. You have the labor market, which is already not looking very good. You have rates and what the yield curve is doing. Feed to oil, I guess, into commodities kind of overall. But yeah, I don't know. I just don't see the other side to it. And I've tried. I've tried. I just can't see the other side. So
Well, I mean, there's also nothing wrong with being a realist, and I think there's nothing wrong with being bearish either. You can have a specific view on the various economic metrics, and if they're pointing to one direction, just because we want a number to go up doesn't necessarily mean that's the case. So
the number will go up. Like it's just about, do you have the cash to buy the dip before it goes up?
Exactly, which is the whole point of having an opinion in the first place, or a pathway on how you see this playing out, because you want to be able to position accordingly. And I think regardless of that, the key takeaway from this whole discussion has been, make sure you have some cash allocation, as to whether that's 40-50% of your portfolio or 5 or 10%. The probabilities would suggest that there's a high likelihood that there could be some kind of correction incoming. And I know that sounds very generalist in terms of the scope, but
you could add this one too, money market.
I mean, yeah, every
Like,
time
here,
it's another red flag.
Yeah, I'll put recessions over here, but you can see money market, right, ramps up into a recession.
I mean, if there's 4 or 5 indicators all pointing to the same thing, again, from a probability standpoint, the data doesn't lie, right? I mean, there's.
Yep.
Well, okay.
And just one last point. I think it's really important people look at the reason that rates are moving higher. It is real rates moving higher. It is term premium, right? It's not, if you look at break evens, which is the bond market's expectation of inflation, they're up by like 3 basis points, right? We've had a decent move higher in rates, but it's all been basically term premium real rates. So because that would be a contra, right? Rates are moving higher. Although I guess you could, but yeah, look at the composition. A lot of people talk about the 10-year treasury yield or whatever. Just look, be sure to like look into it and look at what is moving rates higher. Is it term premium, like we can see here, which has just gone vertical, or is it inflation concerns? It's not inflation. So it's, mostly been term premium.
Gotcha. No, that's a great point to make, and that distinction is key. because everyone just looks at number go up and they don't do a deeper dive into the underlying factors causing that. And that's just because the number goes up doesn't necessarily mean it's bad. It's the underlying
Or good.
Yeah, good or bad. Exactly. So on that note, Infra, thanks so much for joining us on the Daily Stack Macro Thursdays. Thank you, everyone